Hi all, welcome to our webinar on the commodity outlook. We will begin shortly to allow a few more people to join in, and we'll start with our webinar then. Okay, hello everyone, and welcome to the 13th edition of our Commodity in Focus webinar series. My name is Nishita Sharma, and I will be your host for today's session. I'm based in India and currently working as a senior specialist with the Commodities Intelligence and Price Forecasting team here at WNS Procurement. Joining me today are our valued panelists, Vivek Agarwal, Nidhi Jain, Rohan Gupta, and Shruti Pathak. Each brings a wealth of knowledge and expertise in the commodity space. Today, our experts will share insights and market outlooks for various commodities and provide some actionable buying recommendation. This will help you navigate remainder of the year with confidence and make well-informed sourcing decisions, be it cost management, risk mitigation, or budget planning in the second half of 2025. From an agenda standpoint, we will begin our discussion with a quick recap of the first 6 months of 2025, which has been marked by extreme volatility and rapidly evolving market dynamics. This will be followed by our specialists discussing in detail the market outlook for the second half of 2025 across different commodity groups. As we progress through these topics, I encourage you all to engage actively by posting your questions in the Q&A box, which you can find at the bottom of your screen. You can also upvote the questions that resonate with you. We will leave some time towards end of the session to answer these questions. So now, without any further delay, let's begin by looking at what has happened so far in 2025 in the commodity market and what assumptions we have for the rest of the year. Now, as you can see on the screen, the commodity index has experienced an uneven momentum in the first half of 2025, reflecting a tug of war between supply disruptions, policy shocks, and macroeconomic forces. Tariff escalation has been one of the primary drivers. Since early 2025, US President Donald Trump has enacted a series of steep protective tariffs affecting nearly all goods imported into the US. In July 2025, the average applied US tariff rate is estimated at 18.2%, which is the highest level since 1930s. Now, some of the key tariffs introduced that remain in effect include the steel and aluminum tariff of 50%, 25% tariff on imported cars, and a 50% tariff on copper. Tariffs on pharmaceuticals, semiconductors, and other sectors are also pending and may come later in the year. As you can see on the chart as well, the volatility index spiked to 52.3 points in April, which is its highest level in years, as investors recalibrated risk across sectors following the Liberation Day tariff announcement and the baseline tariffs. Trade tensions with China, Canada, Europe, and Mexico, some of the key trading partners, as well as the recent trade deals, have continued to impact the commodity market during the first half of 2025. Now, in addition to this, climate-related disruptions also contributed to commodity price swings. Severe rainfalls and flooding in the Southeast Asia during first quarter of 2025 damaged palm oil, rice, rubber, and tea plantations. Record-breaking temperatures in Europe during June and July also strained the energy grids and increased demand for cooling fuels. Drought conditions affected wheat and corn yields, while heat stress impacted livestock and dairy production. On the geopolitical front, the Iran-Israel escalation in June injected a risk premium into oil and gold, with markets pricing in potential supply disruptions and adding to volatility in the commodity and logistics sector. Now, let's have a look at the performance of some of the macro indicators. US inflation increased by the most since start of 2025 in June, reaching 2.7% and remains well above Fed's target of 2%. June CPI reading indicates that tariffs might be starting to drive up the prices in certain categories. Looking at GDP performance, we can see that growth projections have been lowered across economies, reflecting the impact of intensifying trade tensions and the adjustments in the financial markets. Global growth for 2025 is now projected at 3%, which is a slowdown from 3.3% in 2024. Manufacturing activity also remains subdued globally, with US now 5 months into contraction. Industry sentiment is largely negative, driven by tariffs, geopolitical uncertainty, and weak demand. Europe continues to contract for 37th straight month, and China, the manufacturing sector, showed some recovery in June following the trade deal with the US. However, we see that it has dipped again in July, indicating that the sector still remained under pressure. And lastly, in the first half of 2025, global economic policies uncertainty also surged to a multi-year high. Trade uncertainty remained elevated as businesses grappled with shifting trade dynamics, volatile policy signals, and concerns over global growth. The heightened index reflects the widespread anxiety across the market, with implications for investment, supply chains, and cross-border trade. Now, after having looked at these key trends, now let's have a look at some of our key assumptions for remaining of the year. Starting with the inflationary trend, inflation in the US moderated from 3% in 2024 to a low of 2.6% in the second quarter. However, we expect that it is now likely to rebound to 3.2% by end of the year. China will show signs of stagnation, ending the year with a modest 0.2% forecast, whereas we expect a steady disinflation trend in Eurozone, dropping from 2.3% in quarter 1 of 2025 to around 1.9%. Looking at the policy rates, we expect the US Fed to hold the rate steady in third quarter of 2025 and then lower them by around 50 basis points in the fourth quarter. On the other hand, European Central Bank will continue with the aggressive easing during the second half of the year. Coming to our energy forecast, oil prices will remain in the range of $66 to $72 per barrel in the remaining of the year, driven by concerns around potential US sanctions on Russia, which will be likely countered by an output increases by the OPEC Plus cartel. Natural gas will also remain volatile, with price rise expected in the fourth quarter. Moving on to the key end use sectors demand, construction is projected to remain under pressure globally, especially in the US and China, due to higher financing costs and weak demand. In the automotive sector, China is likely to see the growth taper off by the end of the year, while US and the Europe will show signs of cyclical recovery but will remain weak overall. And lastly, the freight rates are projected to decline steadily after witnessing a sharp rise in the first half of 2025, reflecting easing supply chain pressures and softer global trade. So now, after having developed a good understanding of the current market and our assumptions, we will now move on to the detailed commodity outlook. Over to you, Vivek.
Thanks, Nishita. In today's metal section, we will be covering the outlook for the key base metals like aluminum and copper, US steel, and the rare earth oxides. But before we look ahead, let's first understand what happened in the first half of 2025. Starting first with aluminum, aluminum prices followed an upward trend in the first half, mainly due to imposition of a 25% tariff by the US in early February, which was later increased to 50% in June 2025. At the same time, the EU included Russian aluminum in its 16th sanction package, triggering supply concerns in the region, which had sourced roughly 8% of its shipments from Russia. The US Midwest premium also witnessed a sharp increase of around 180% between January till July 2025. And this spike was majorly due to the US tariff hikes and compounded by limited smelting capacity and a 58% year-on-year drop in COMEX stocks in first half. Now, looking at the outlook for second half, the LME aluminum is expected to trade in the range of $2,500 to $2,700 per ton, about 2 to 3% higher on average compared to first half. This is primarily due to continued low inventory levels across LME and SHFE warehouses. Further, China's commitment to halt any new capacity additions beyond 45 million tons may pose supply risk during the end of 2025. On the demand side, China's stimulus announcements, including trade-in policy for appliances and NEVs, along with the rollout of over 1,400 national projects, are expected to lift buying sentiments globally. In the US market, the Midwest premium is expected to remain at a record high throughout Q3, supported by ongoing supply concerns. In May 2025, the US aluminum imports dropped to their lowest level since December 2022, with a significant portion of a decline coming from Canada. Alcoa, a major aluminum producer in Canada, has already diverted around 100,000 tons of aluminum away from the US market in response to these tariffs. That said, we do see a potential softening in premium towards the end of the year as record high premium begin to weigh on demand within the US aluminum sector. Now, coming to our recommendation, we suggest that buyers begin their securing aluminum requirements for the first half of 2026 during August-September. Prices are expected to recover from their current levels, driven by supply side risk and improved sentiments, supported by likely US Fed rate cuts and China's economic support measures. For US buyers specifically, we recommend need-based buying in the short term and avoiding excessive stockpiling, as premium are expected to fall in Q4 amid weaker demand. Moving on to copper, as you can see in the graph, both LME and CME prices witness a rising trend over the first half of 2025, majorly supported by global supply concerns, indicated by a sharp drop in LME and SHFE warehouse inventories. This is due to rerouting of copper shipments towards the US amid the widened CME LME price spread ahead of potential imposition of copper-specific tariffs by the US. In first half, the CME LME copper price spread surged above $2,500 per ton, significantly above the usual $250 per ton. Now coming to outlook, on CME front, after witnessing a sharp 20% decline on 31st July, following US decision to not to add refined copper under tariffs, we expect prices to trade below $10,000 per ton in short term, in line with a record high inventories at the CME warehouses and continued inflow of refined metal into the US. However, prices are likely to increase starting October, in line with potential drawdown of CME stocks, with spread between CME and LME ranging at $700 to $1,000 per ton. On the LME side, we expect prices to trade in the range of $9,200 to $10,000 per ton in the second half. In quarter three, prices are likely to remain range bound, in line with an increase in LME stocks amid rise in exports from China and bearish sentiments amid ongoing tariff uncertainty. As per market estimates, China may export around 80,000 tons of refined copper on the CM LME warehouses in Asia during quarter three. However, the LME prices are expected to trend upwards in quarter four, supported by demand recovery from renewable energy sectors, likely rate cuts by the US Fed, and further stimulus measures from China. As for buying strategy, we recommend buyers to lock in their first half of 2026 copper requirements in August itself. Both LME and CME prices are expected to climb further due to supply constraint and improved demand sentiments driven by monetary easing and stimulus effort. Next, we have steel for the US. So steel prices in the US surged in the first half in line with supply concerns following a 25% tariff on all steel imports by the US, which was further increased to 50% in June. Also, panic buying by downstream buyers amid anticipated further trade restrictions supported uptick in prices in the first half. Going forward in the second half, we project prices to trend downwards in line with muted downstream demand and a rise in domestic supply. US automotive sales are forecast to decline 3% on an annual basis in the second half, whereas the crude steel production may rise 4% on an annual basis in the remaining 2025. In addition, reduction in steel tariff to the UK, along with a likely exemption of steel imports to the EU, is expected to ease supply concerns, thereby may pressurize prices downwards. However, China's anti-involution movement to stop low-priced competition and to remove outdated capacity from the market will bring volatility in the global steel market, which may limit the upside risk. Moving on to recommendations, buyers are advised to procure requirements for first 6 months of 2026 in October 2025, as prices are likely to increase thereafter in line with a likely rise in feedstock iron ore prices, along with an improvement in buying sentiments following interest rate cuts by the US Fed. Lastly, in rare earth, we will be covering the praseodymium and neodymium oxide market. In first half, prices of both oxides saw an upward trend driven by China's policy measures aimed at regulating the rare earth sector. On 19th February, China issued a regulation banning private firms from mining, smelting, or separating rare earth, allowing only large state-owned companies to operate in an effort to curb illegal mining. Additionally, new export permit regulations announced in early April caused shipment delays, fueling global supply concerns. China accounts for nearly 60% of the global rare earth supply. Furthermore, supply disruption from Myanmar due to political unrest and higher export tariff due to reduced inflow of rare earth feedstock contributing to a tighter market and upward pressure in the first half. Now looking ahead, Prices are expected to increase further in the second half, supported by persistent supply concerns from China and rising input costs from Myanmar. Additionally, the 10-year contract between the MP Material and the US Department of Defense, which sets a floor price of $110 per kg for both neodymium and praseodymium products sold or stockpiled, is likely to support higher rare earth prices in the Western market. For buying recommendation, we suggest buyer consider securing material for the first 6 months of 2026 now, as prices are expected to continue rising amid sustained supply concerns. That's all from the metal side. Now I will hand over to my colleague Nidhi, who will take you through the agro market. Over to you, Nidhi.
So thank you, Vivek. Now, after a deep dive into metals, let's move on to agricultural segment. I'll walk you through grains, vegetable oils, oleochemicals, and coffee market. So, starting with grains, we will focus on corn and wheat market for the US. Wheat prices in the US are expected to remain soft through second half of 2025, driven by ample supplies and seasonal rise in the supplies from the Northern America. In the US, the total wheat production is projected to decrease 2% year over year in the marketing year 25-26, primarily due to reduced acreage for US spring wheat and drought conditions witnessed during the sowing period. However, this decline would be mitigated by high carryover stocks from the last year, which will boost the stock to use ratio for wheat to 44% in the US, which would be the third highest on record. Which will be the third highest in 3 years. Additionally, the European wheat output is set to rise 12% during the marketing year 25-26 on favorable weather, while Russian production is expected to recover to 83.5 million tons. This, combined with larger than expected production in India, is likely to exert downward pressure on the US wheat exports. However, the weather-related concerns which persist in Ukraine, China, and southern Australia may constrain the output and limit the extent of the global supply availability. Nonetheless, the global surplus outlook and the competition from low-cost origins will likely cap the US prices in the range of 5.5 to 6 US cents per bushel for second half of 2025. Hence, we recommend to avoid buying now and wait for the prices to bottom out. Now, moving on to corn. The global corn supplies are projected to remain ample throughout marketing year 25-26, with output forecast to rise 3.1% year over year. And this will be supported by high production across key export regions. In the US, the corn output is projected to increase 5.6% year over year in marketing year 25-26, which will be the largest crop on record. This would be driven by higher rains, which improve the soil moisture and accelerated sowings. Alongside a 2.7% year over year drop in exports will lift the US ending stocks by 23.7% and raise its stock to use ratio to 10.8%, which will be higher than the past 5-year average of 9.6%. Now, in the Brazil also, it will harvest its second corn crop and boost supplies. And the production for marketing year 24-25, that is ending in February 2026, is likely to rise 10.9% on account of better yields in Brazil. Additionally, gains are expected in Ukraine, Russia, and the Europe, with production projected to increase in these regions at 13.8%, 7%, and 1% respectively. As on recommendation, it is with the price expected to remain weak in the range of $3.6 to $4.2 per bushel. Procurement for second half of 2026 can be optimally timed at late quarter 3 of 2025. Now, moving to vegetable oils. The palm oil prices are expected to remain elevated through second half of 2025, supported by policy-driven demand and tight stock levels. Indonesia is expected higher biodiesel mandate of B14 Indonesia will continue to absorb the large amount of domestic palm oil and curb exports. Also, at the same time, India and China are stepping up its imports to build up its inventory levels ahead of the Q4 festive season. In Europe, the upcoming EUDR, that is European Union Deforestation Regulation, effective January 2026, is triggering preemptive buying, adding short-term upside pressures. Now, moving on to the supply side, the global palm oil production is set to rise marginally in marketing year 2025-26, with output around 3% increase in Indonesia and a marginal increase of 0.5% in Malaysia. However, this modest growth will be outpaced by strong demand and with low carryover stocks from marketing year 24-25, with stock-to-use ratio projected to fall 19% below the past 5-year average of 22%, marking one of the tightest supply scenario in the recent years. Also, the palm oil prices are projected to trade between 1,000 to 1,100 USD per ton in second half of 2025. Hence, buyers are advised to delay their procurement until late Q3 of 2025 for its first half of 26 needs, when seasonal production improves and India and China demand eases. Now, moving on to soybean oil. For soybean oil, the prices are likely to remain stable amid strong US biodiesel demand and ample global supply. US policy tailwinds, including expanded EPA blending targets and extended clean fuel tax credits, will drive domestic usage. Additionally, a new rule excluding non-North American feedstocks boosts reliance on soybean oil. Despite this, supply-side pressure persists. US soybean oil output is projected to grow 4% year over year in marketing year 25-26, with ending stocks rising 15%. Globally, soybean production is projected to increase 1.5%. Meanwhile, South American production is projected to rise 4% year over year, with South American exports set to rise 40% year over year in second half of 2025, supported by Brazil's second consecutive year of strong soybean output, undermining US exports competitiveness and ongoing trade tensions with China. Soybean oil prices are expected to range between $1,200 to $1,400 per ton in the second half of 2025. So the procurement strategy could be timed for 2025, when new US crop arrivals may ease pricing, though festive-led consumption could lead to firm prices in Q4. Now, moving on to oleochemicals. Prices for mid-cut fatty acids and fatty alcohols are expected to remain under pressure in second half of 2025, largely driven by tight feedstock availability, lingering impacts of production outages, and demand firmness. Recent gas disruptions halted two major Malaysian plants with capacity of about 380,000 per tons per year in Malaysia. Both the plants have now resumed operations, easing short-term turbulence. Additionally, demand from the downstream surfactants and personal care sector is holding firm, intensifying competition for available fatty acids and fatty alcohols. CNO, which is the key reason for the price upward movement, is expected to stay elevated in second half of 2025, driven by tight supplies and resilient demand. Structural yield decline in the Philippines, linked to aging trees, El Nino effects, and limited replanting remains a key constraint. Output is also falling in Indonesia, Sri Lanka, India, worsening regional supply tightness. Despite high prices, the demand from premium personal care sector and green fuel industry remains firm due to product positioning around coconut origin inputs. Strategic and speculative buying, especially ahead of the EUDR enforcement, continues to support pricing. Now, moving on to recommendation, we expect prices to remain firm for fatty acids and alcohol market amid ongoing demand resilience and strong feedstock prices. Hence, we suggest buyers should lock volume early if sourcing traceable grades for European markets. Moving on to coffee. It's the final segment for agro section, where we will focus on Arabica coffee prices. The Arabica coffee prices in the US are anticipated to experience a correction in second half of 2025 as global supply conditions improve and demand shift towards Robusta coffee beans. While Brazil's Arabica output is forecast to decline 6% year over year due to favorable weather in Minas Gerais, the top Arabica producing region, this is being offset by a sharp rise in Robusta supplies. Brazil projects a 14.8% year over year increase in Robusta production, while Vietnam, which accounts for about 40% of global Robusta output, is expected to rise 7% year over year. Improved weather situation and stock prices have supported higher acreage and yields. So globally, the Robusta production is projected to grow 8% year over year. US Arabica demand remains muted due to the import cost uncertainties and weak consumer sentiment. These combined factors are expected to ease upward pressure on prices and support a gradual correction in second half of 2025. Buyers may cover their position now for quarter 4 of 2025 as prices are likely to increase in quarter 4 amid increased consumption and during the festive season for HRI sector, that is hotel and restaurant sector. Now I'll hand over the mic to my colleague Rohan Gupta.
Thanks, Nidhi. Now we move on to the chemicals category where we will be covering methanol, acetone, and caustic soda. Let's start with methanol. During the first half of the year, methanol prices in North America and Europe witnessed a substantial decline from peak levels in the fourth quarter of 2024, driven by capacity resumptions, which improved methanol supply, weak demand from the derivative formaldehyde sector, along with bearish market sentiments due to concerns around US tariff, possibly impacting demand outlook for 2025. In the US, roughly 37% of capacity turned online in the first half of the year, comprising key plants such as Natgasoline and Methanex Geismar 3 unit, along with OCI Beaumont and Methanol Corporation. In Europe, approximately 20% of capacity turned online in the first quarter of 2025, comprising production units of Equinor, BASF, and Total Energies. Adding to this, a surge in imports to Europe in the first quarter from the countries such as US, Venezuela, Trinidad, and the Middle East kept inventory levels sufficient in the region, supporting price correction. As we look forward, prices in the US and Europe are expected to remain subdued in the second half of the year compared to the levels in the first 6 months, driven by sluggish demand outlook from the end-use construction and automotive sectors, which may keep demand from the methanol muted from key derivative industries such as formaldehyde and acetic acid. Moreover, a sufficient methanol supply globally is likely to support bearish sentiments in the market. On the other side, a rise in feedstock natural gas prices, along with supportive policy developments such as US trade negotiations with Europe and economies like China and Japan, are likely to support price recovery from historic low during the end of second quarter, which may limit downside risk to the prices. Talking about China, methanol prices witnessed a sharp correction in the first half of the year, in line with the global trend, driven by a decline in feedstock coal prices and improved supplies from Iran. China is a net importer of methanol, and Iran accounts roughly 18% of its total methanol imports. Supplies from other Middle East regions such as Oman, UAE, and Saudi Arabia also remain adequate. Going forward, prices are forecast to remain bearish in the second half of 2025, but may witness a marginal recovery driven by expectations of high operating rates of derivative MTO plants, which may improve methanol offtake. However, domestic capacity additions of methanol plants and subdued feedstock coal prices may continue to exert downward pressure on prices. We expect new capacity additions of roughly 500,000 tons in Asia during the second half of the year. Coming on to the recommendations, we suggest that the buyers should cover H1 2026 requirements by the end of quarter 3, as prices are foreseen to recover starting the fourth quarter, driven by increase in feedstock prices, which may support an uptrend in global methanol levels. Now, we move our focus to acetone. Acetone prices globally witnessed a price correction in the second quarter of 2025, driven by a drop in upstream crude oil prices, which supported a fall in levels of benzene and propylene, which are key feedstocks for acetone production. Further, supply improved across regions with plant resumptions and new capacity additions. In the US, Shell and Olin plants resumed operations during the second quarter, accounting for roughly 26% of North American capacity. In Europe, key plants such as Borealis and Domo resumed operations in the second quarter, which improved the supply situation in the region. Asia, particularly China and Korea, also witnessed new capacity additions for acetone. Going forward, prices are expected to continue the downtrend in the second half of 2025, mainly driven by ample supply and weak demand outlook. Globally, foreseen weak bearishness in the construction and automotive industries in the second half of the year are anticipated to keep demand from derivatives such as methylacrate and bisphenol A restricted. Moreover, a 25% tariff rate on imports of automobile by the US may likely limit significant rise in demand. Further, downstream plant closures in the US may keep buying sentiments muted. A key methacrylate plant in the US with a capacity of roughly 160,000 tons per year is expected to close its production facility in the third quarter. This will remove roughly 80,000 tons of annual acetone demand from the market. Having said that, scheduled maintenance of acetone units in the fourth quarter is anticipated to stabilize prices during late 2025, balancing the downside risk from feedstock, benzene, and propylene prices. Overall, we suggest that the buyers should avoid inventory buildup in the third quarter, driven by expectations of further price correction due to ample supply in the market. Buyers can look to cover exposure for early 2026 during the end of the fourth quarter, as prices are likely to attain saturation by year-end, which is expected to provide a buying opportunity. That concludes acetone. Now, let's move our focus on caustic soda. During the first half of the year, prices remained range-bound in North America and Europe, driven by upside pressure from supply constraints and plant turnarounds, which was balanced by a drop in upstream electricity prices and bearish market sentiments due to tariff-related developments. Going forward, prices in the US are forecast to remain subdued during the third quarter, driven by sufficient supply expectations on account of strong operating rates, along with policy developments which may restrict export demand. The operating rate of caustic soda plants improved on a monthly basis in the second quarter from 73% observed in April to 84% in June. The rates further improved to 87% in July, ensuring sufficient supply in the market. Additionally, Mexico announced an anti-dumping tariff of $195 per metric ton on caustic soda imports from the US, which took effect from June 2025. Moreover, as per the market sources, the Brazilian Chemical Industry Association has submitted a proposal to the country's federal government seeking to raise the external common tariff applied to imports of caustic soda to 18% from the current levels of 7.2%. These policy developments, along with possible retaliation by Brazil in response to 50% tariff imposed on the country by the US, may limit export demand of US caustic soda. From the trade standpoint, Brazil and Mexico combined accounts for roughly 55% of total US caustic soda exports. Having said that, a foreseen rise in the US electricity prices, which is an upstream for caustic soda production, along with possible supply disruptions due to the hurricane season, may induce upward pressure on prices during the fourth quarter of the year. Coming to Europe, prices are likely to remain range-bound in the second half of the year, mainly driven by foreseen supply constraints. Approximately 6% of caustic soda production capacity in Western Europe is expected to go offline during the third quarter. However, this is likely to be balanced by weak downstream demand and bearish energy prices. Now talking about caustic soda market in Asia, prices trended downward in the first half of the year, mainly driven by a significant fall in upstream coal prices, which posted a drop of 40 to 45% in the first half of the year compared to the previous 6 months. Further, healthy inventory levels in Asia and sufficient supply ensured ample inventory, keeping levels subdued. Moving forward, prices are expected to continue the downtrend movement in the third quarter, driven by capacity addition and continued weakness in coal prices. Roughly 900,000 dry metric tons of new caustic soda production capacity is likely to come online during the second and the third quarter of the year in the Asian region. However, we expect that the prices to turn marginally bullish at the start of the fourth quarter, supported by an improvement in downstream demand. 8 new alumina refineries, accounting for roughly 7% of global alumina supply, are anticipated to come online in Asia during 2025, leading to an additional caustic soda requirement of roughly 2 million dry metric tons per year. Moreover, 5 new pulp facilities are expected to start up in Asia, which may induce demand for caustic soda. From the recommendation standpoint, we suggest that the buyers can look to cover remaining Q4 positions and H1 2026 requirements by the end of the third quarter, as we expect that capacity additions of downstream plants may lead to a demand-driven surge in caustic soda prices globally, which may be supported by tight supply due to scheduled plant turnarounds, inducing price recovery in the fourth quarter. That brings us to the conclusion of the chemical section. Now I hand over the mic to Shruti, who will walk through the resins market.
Thanks, Rohan. So under the resin section, we'll be discussing both virgin and recycled resins. Let's begin with the outlook for virgin resins, focusing on 4 key types: HDP, PP, PET, and PVC. As you can see on the below table, we expect that in the second half of 2025, prices for HDP and PP will witness a drop compared to the first half of 25 average price levels. Key factors to exert downward pressure on prices are drop in feedstock propylene and ethylene prices, driven by fall in upstream crude and naphtha prices. Also, the ample supply across resins may support the downtrend in prices. In the first half of 2025, around 5.5 million tons per year of new PE capacity came online in Asia, primarily in China. Another 4 million tons of PE capacity is anticipated to come online in the second half of 2025, which is likely to aggravate the existing global PE oversupply situation. Similarly, 7.2 million tons per year of new PP capacity got added in the market in the first half of 25, and another 3.1 million tons per year is expected to be added by second half of 25. Another important factor is the uncertainty regarding US tariffs. The volatility and unpredictability has severely impacted the demand environment. Consumer spending sentiment is down, as is business confidence. Automotive, construction, and packaging, which are significant demand sectors for many ethylene and propylene derivatives, are particularly bearish in their outlook. However, Atlantic hurricane season in the US is likely to cause plant outages, which may tighten availability in the region and limit the price fall for HDP and PP. There is 60% chance of above normal Atlantic hurricane season this year. Now, let's talk about the outlook for the other 2 resins, that are PT and PVC. Here also, prices in the second half of 2025 are expected to drop compared with first half of 25, driven by decline in feedstock paraxylene and ethylene prices. The PVC market is expected to remain well supplied globally in the second half of 25. Demand is soft due to struggling construction and automotive sectors, which are major downstream industries for PVC. Additionally, the US PVC exports to major export destinations like India, Mexico, and Brazil may get negatively impacted amid likely imposition of anti-dumping duties by these countries. US exports close to 24% of its total PVC exports to India, Mexico, and Brazil collectively. The Brazilian government has approved an increase in the current 8.2 anti-dumping duty tariff imposed on US PVC to around 43.7%. The ongoing tariff impositions by the US and prospective retaliations by the trading partners may continue to dampen buyer sentiments. For PET, new plant additions in the second half of 24 has led to ample supply of the resin in 2025 as well. Additionally, anti-dumping duties imposed on China, which is a major player in the PET market, may lead to increase in supply there and create bearish market sentiments. Mexico has announced definitive anti-dumping duties on Chinese PET imports effective 30th May. China exports close to 2% of its total domestic production to Mexico. Further, Canada made prelim determinations of dumping of PET resin originating in or exported from China and Pakistan. Further, the imposition of import tariffs by the US on PET intermediates like PX, PT, and MEG is likely to limit their supply in the US and lead to oversupply in Asia and the Europe. However, as I already mentioned in the PE and PP section, the Atlantic hurricane season in the US may cause plant outages, tightening availability in the region. Now, from the recommendation perspective, buyers can avoid stocking up right now and suggested to build stocks during Q4 of 25 for the first half of 26 requirements, as prices may start to rise from beginning of 26 amid seasonal plant turnarounds and start in restocking demand. Next, we'll shift our focus to the recycled resins market in Europe, which leads globally in the adoption of recycled plastics, driven by its strong sustainability targets and circular economy regulations. The recycled HDP market is under pressure, driven by weakened demand and an oversupply of material. In response, producers have scaled back production to control inventory levels, which has negatively affected profit margins. Additionally, the narrowing price gaps between virgin and recycled plastics is prompting many buyers to choose the more cost-effective virgin alternatives. The European market for recycled PP remains in a prolonged downturn, with weak demand projected to continue through at least 2026 due to ongoing challenges in both industrial and consumer sectors. New EU regulations requiring the use of recycled plastics in vehicles, especially from the end of life cars, present a promising opportunity to strengthen future demand and increase the availability of PP waste. However, a near-term recovery in RPP prices is unlikely as market sentiments remain cautious. Europe's RPET market is witnessing uptick, partly influenced by an ongoing investigation into virgin imports from Vietnam. However, the broader market sentiment suggests limited support for sustained price hikes, with RPET pellets and flake supplies considered adequate. Economic and geopolitical instability are contributing to pricing uncertainty. Meanwhile, feedstock markets are reflecting typical seasonal patterns. The hot weather is boosting beverage sales, improving availability, and contributing to a decline in bale prices. The market is likely to stay cautious, with demand remaining steady but subdued through the end of the year, influenced by underlying challenges such as energy cost and broader macroeconomic pressures. Now, the market needs to keep an eye on some of the most recent recycled plastic initiatives in Europe, which may improve the demand of recycled resins in coming years. First is the new EU rules for chemically recycled plastics. The European Commission launched a public consultation on new rules for chemically recycled content in single-use plastic beverage bottles. These rules aim to standardize how recycled content is calculated, verified, and reported. Encourage chemical recycling where mechanical recycling isn't feasible. Example, food-grade plastics. Then exclude plastics used for fuel from being counted as recycled, and require third-party verification for complex recycling stages. Secondly, the EU Single-Use Plastic Directive has set some 2025 targets for reducing plastic waste. The first is 77% collection rate for plastic bottles by 2025, rising to 90% by 2029. Then 25% recycled content in single-use plastic beverage bottles made of PET by 2025, and 30% in all single-use plastic beverage bottles by 2030. Lastly, 50% reduction in single-use plastic items like straws, cutleries, and takeaway containers. Some countries are already ahead. France exceeded the 25% recycled content target in 2024. Germany has over 90% collection rates thanks to its bottle return schemes. The other is €8 billion investment in chemical recycling. Plastics Europe, a major industry group, announced plans to invest around €8 billion in chemical recycling infrastructure. The goal is to produce 1.2 million tons of recycled plastic by 2025 and 3.4 million tons by 2030. This supports the EU's circular economy goals and reduces reliance on virgin plastics. So that's all on virgin and recycled resins, and this brings us to the end of the webinar. The platform is open for questions now. Over to you, Nishita.
Thank you so much, team, for sharing the insights on the commodities. As Shruti mentioned, we have now opened our floor for questions. Request you to post your questions in the Q&A box at the bottom of your screen. So we can see a few questions already on the Q&A, so we'll start. Okay, so The first question we have is, do you expect the CME LME copper price spread to exceed $2,500 per ton again in 2026? So Vivek, if you can throw some light on this question.
Sure, Nishita. So at this stage, we do not anticipate the CME LME price spread widening again to over $2,500 per ton in 2026. So the sharp spread observed earlier was largely a reaction of the unexpected 50% tariff on copper imports. However, with the current exemption of refined copper and scrap, which together accounts for approximately two-thirds of the total US copper imports, we do not foresee a supply crunch in the US market at this point in the year 2026. Additionally, the US is currently sitting with record 20-year high inventory levels, which further eases the supply concerns in the market. Hence, we do not expect spread to widening again to more than $2,500.
Okay, thanks Vivek for sharing the insights, and I hope we are able to answer and the question. Another next question also, Vivek, is for you. Any outlook for germanium for Europe? If you have any idea, if you can provide some outlook over here.
I was not expecting any questions on germanium, so I don't have a quantitative outlook as of now handy at this moment, but I can provide some qualitative view. So
Sure.
germanium prices in Europe are currently at an all-time high of around $4,500 per kg, having surged nearly 300% since 2023. And we expect prices to rise further in short term amid acute regional shortage following China's 2024 export controls on dual-use items, including germanium. Further strong demand from the defense and optic wiring cables continues to support the market demand. Yeah, so that's all we have on germanium now.
Sure. Thanks, Vivek. Next question would be on agro. So maybe Nidhi can help us provide some insights here. Could you throw some light on narrowing spread between the soybean and palm oil prices?
Sure, Nishita. So these narrowing spreads between soybean and palm oil could be a new norm. So prior to 2024, the spread between the two oils remained around $200 to $300 per ton, with soybean oil being the expensive one. But with the increased availability of soybean oil over the past 2 years, along with the tightening palm oil supplies over the last 2 years because of lagged impact of El Nino impact on the palm oil yields, specifically in Indonesia, led to a tightening supply situation for palm oil and also the higher demand from the biodiesel sector. So now this has led to the narrowing spread between the two. In fact, for the second half of 2024, the spread went into a negative territory where soybean oil was sold at a discount to palm oil, which is unusual case. So now in the moving forward, the narrowing spread of about $100 to $200 tons could be a new norm for these oils, with soybean oil trading at a premium of $100 to $200 per ton to palm oil, or even less.
Okay. Thanks, Nidhi, for this. I think the next question is also on vegetable oil. Seems like a hot topic. So, what do you see as the major risk affecting the future supply of coconut oil?
Yes, absolutely. It's a hot topic, and the prices for coconut oil has spiked about 300% over the past 1 year, starting from $1,000 per ton to trading around $3,000 per ton now. So the key reasons for it is the tight supply in the market from the Philippines, and this situation is likely to continue because of the structural decline in yields in the Philippines linked to the aging trees, underinvestments in the Philippines coconut plantations, and limited replanting activities. So all of these factors, along with the lower yields after having all-time high yields during marketing year 2021 to marketing year 24, the yields, the trees are now into a relaxing phase where the yields are also declining. They dropped 11% in marketing year 24-25 and are expected to recover only marginally in the next marketing year. So production is likely to remain tight, and Philippines is the largest producer and exporter of coconut oil, accounting for about 60% of the global production and 60 similar amount of ratio in terms of exports. So that is going to be tight in the market. Additionally, we are going to enter into the typhoon season from September onwards, and any significant typhoon could lead to a further supply disruption in the coconut oil market and push up the prices. However, as per the latest Pagasa estimates, we do not see any major typhoon in the market. So yeah, that's the supply tightness is likely to persist for remaining of the 2025 and into 2026. Hope that answers the question.
Yeah, Nidhi, I think yes, and definitely coconut oil would be something to watch out for in the next 3 to 4 months. I hope this answers your question, Ruth. Next, we have some questions on chemicals, so maybe Rohan can help us here. Can you shed some light on the factors impacting the bearish demand outlook for methanol in the US and Europe, and moderate levels foreseen in Asia? So, some of the key factors that are leading to the difference in the trends that we are seeing.
Thanks for your question, Nishita. So, as we covered earlier, demand in the US and Europe is foreseen to witness bearishness. It is mainly driven by the sluggish outlook for the construction sector that may limit demand from the derivative formaldehyde sector, which accounts roughly 29% of overall methanol offtake. Moreover, we expect that the offtake may be limited from the acetic acid sector as well, which accounts roughly 9% of methanol demand. So that gives us broadly a bearish outlook for methanol in the US and Europe. When we come to China, foreseen resumption of downstream MTO plants in the second half of the year may support methanol offtake in the region. However, the uptrend may be limited due to the deep state of the construction industry in China, which may limit demand recovery, keeping the outlook at moderate levels.
Thanks, Rohan. That really answers the question well. And to the audience, I would like to say we have like 3 minutes left into the webinar. So if you have any other questions, please post it in the Q&A section. Rohan, next question is also for you. What is the main driver pushing down acetone prices globally in the second half of the year?
Okay, so that's an interesting one. So we have seen a consistent price correction in the first half of 2025 in the acetone market. I think the market, I would put an equal weight on the weak demand as well as ample supply, which would drive the market in the remaining 2025. The new capacity additions in Asia, I think it was roughly around 465,000 tons, is likely to add supply in the region. Further, capacity resumptions post the seasonal spring turnaround in the second quarter in Europe and North America, along with healthy operating rates, is expected to keep production volumes high. When we talk about the demand, the imposition of 25% auto tariffs by the US and the foreseen closure of derivative methyl methacrylate plants and bisphenol A plants is expected to keep acetone offtake muted, adding to market surplus. However, in the past week, as per the market developments, the recently concluded trade deals of the US with the EU, Japan, and South Korea, reducing the auto tariffs to 15% from the respective regions, may induce or improve demand from the automotive sector, which may limit a significant downtrend.
Okay, thanks, Rohan. I hope we have answered the question, and you have gotten the insights for on this question. Next, I think, is a question we have on recycled resins. So, Shruti, if you could help us, how does the newly adopted EU packaging and packaging waste regulation differ from previous national frameworks like Spain's Royal Decree?
So this new regulation not only surpasses the previous framework based on directives, but it also requires member states to thoroughly review their national models. And the differences are not minor. While Spanish regulations advocate for indicative prevention and leaves room for future measures based on evaluations, the European framework establishes clear obligations with defined deadlines and binding metrics. So I hope this answers your question.
Thanks, Shruti. Next is also on Europe's recycling. So, How will the EU's new rules on chemically recycled content impact the chemical industry, and what broader role do they play in shaping future recycling policies?
So by encouraging the investment and backing new recycling technology, these rules are set to make EU's chemical industry and manufacturers more competitive. These measures will also benefit the environment as they will economically incentivize producers to reduce plastic waste. And the calculation is expected to become a blueprint for similar rules in other sectors like packaging, automotives, or textiles. The goal is to give investors the confidence that these recycling technologies have long-term potential and staying power.
Okay, that's pretty insightful, Shruti. Thank you so much. The last question we have is, can the slides be shared? Yes, we will be sharing the slides with the participants post the webinar. And in addition to that, we will also upload the recording of this webinar on our YouTube channel soon. So you can also keep a watch on the WNS Procurement YouTube channel for more details on this. I guess we don't have any other question remaining. So with this, we come to end of our webinar today. Thank you everyone for joining us today. Hope you found the session insightful. Thank you so much. Have a great day ahead.